Good morning, everyone. This is John Kogan. I'm the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar entitled A New Single Approach to Lease Accounting. What do the new International Accounting Standards Board / FASB changes to lease accounting standards mean for your organization? In today's presentation and panel discussion, we will take a deep dive into the potential impacts of the agreements to date, and we'll discuss some of the issues that remain on the IASB FASB agenda for early 2013. We've got a wonderful crew today, including practitioners, technology experts, and a number of folks who are very, very deep on these new lease regulations. So we're very happy to be bringing this event to you today and thrilled at the caliber of professionals that we have helping us understand what is going on and where these things will likely end up. Now, I have a few items to discuss on the way to getting started here. First off, a quick welcome to Proformative. Proformative is the largest and fastest growing online resource for finance, treasury, and accounting professionals. We welcome you here. You're joining a crew of over 600,000 of your peers who interact either at events like this or online at Proformative.com. So welcome to all. Next up, a few notes on this morning's event. A link to today's presentation and a link to the video of this webinar, which we're recording right now, will be sent out to all attendees within 24 hours of this event. It will also be posted at Proformative.com/resources. So if you would like to print this out, follow along, etc., you can grab the deck right now. It's at Proformative.com/resources and ready to go. That, of course, is freely available. Next up, we do offer CPE credit for today's webinar. Hopefully you pre-registered for CPE credit by clicking the box during registration. If you neglected to do that, you'll see contact information for Christine Brower right there at the end of this bullet. So please feel free to contact Chris at any point in time if you have any questions about CPE credits. Now, further to CPE credits, we will be putting out 3 polling questions throughout today's event. If you want your CPE credit, you do need to respond to each of those questions. However, the questions are statistical in nature. We would love everyone to participate, even if you're not here for CPE credit. So keep an eye out for those polling questions and please participate. Next up, speaking of participation, please ask questions as we go. You will see, if you take a quick glance at your GoToWebinar control panel, there's a section there called Questions. You may have to expand it by hitting that little plus sign. But please feel free to ask questions at any point today. We do have a Q&A section at the end of the presentations today. So we hope to be able to get to all questions that are asked at that point in time, but feel free to ask them. And any questions we don't get to during today's webinar, we'll do our level best to follow up after the event and get your questions answered. Finally, at the end of today's webinar, you will be asked to take a short survey. It's about 60 seconds long regarding today's webinar. In that survey, we make it very easy for you to request the ability to connect with any of today's speakers. So if you want to be connected with any of the speakers from today's events, just a mouse click away during the post-event survey. All right, we have a number of learning objectives, and fundamentally, we'd like to bring everyone up to speed on the latest lease accounting standards, where they are today, where we think they're going, what the impacts will be to those who adopt these standards. That's a lot of ground to cover. We're going to certainly do our best to get there. We have just 60 minutes to do it, so it's a lot to get through. We certainly won't hit every level of detail, but hopefully give folks a good view into what's going on and probably more importantly, give you some insight as to how you can prepare yourself and your organization for these upcoming changes. A quick look at the agenda. I'm just about done during the welcome and opening comments. We are going to have a really quick overview of the new leasing rates as they stand today from Pete Graham, who I'll introduce momentarily. Then we'll be hearing from the Manager of Accounting Policy at General Mills, Angela Aman. who will discuss what she and her group at General Mills have been doing to prepare for these changes. Then we'll be taking a closer look at the proposed standards changes, and we're going to hear from the four gentlemen listed there, who I will introduce at that time. And then we certainly hope to have some good time to take questions from the audience and hear from all of today's presenters as we go through those audience questions. So that's a quick look at today's agenda. And without further ado, let's go ahead and get ourselves kicked off. And helping us on that front this morning is Pete Graham. Pete Graham currently leads the global activities on IFRS, accounting change, and mobility for finance solutions at SAP. He often helps customers understand the latest information about SAP solutions and how those solutions can make their companies run better. Pete also works with SAP colleagues and partners to bring new solutions to market. He has 15 years of experience in the enterprise software industry in a variety of product and operational roles. And Pete, welcome this morning, and please do take it away. Okay, well, folks, I'm sorry we're having some audio difficulties with Pete, who we were hearing just a few minutes ago. Well, my apologies, folks. I think what we're going to do is actually ask another presenter to grab these slides. And thank you to Sean Tor for offering to do that. Sean, I've just given you control, although if you like, I can actually forward the slides for you and get us into this. Sean, do you want to jump in?
Yes, John. Good morning, good afternoon to everyone on the line. John, if you wouldn't mind just forwarding the slides, that'll be helpful.
You bet.
So very good. With respect to the lease standard, we've obviously been down a long journey here for a while now around the topic. The FASB and the IASB are definitely coming closer to getting to a point of agreement. They've actually been going through the summer, finalizing many of the deliberations, and are getting close to reissuing their second exposure draft on the topic of leasing. So we're expecting that in the first quarter of 2013. The boards have both indicated that the standard will be finalized at least in 13 or maybe 14. It's still yet to be determined, but they have indicated that it's in the kind of the hopper still. The main objective of the proposed rules is to really eliminate the current model of accounting where we have operating and capital lease accounting. And it basically will bring all leases, with the small exception of very short-term leases, onto the balance sheet. So it really will help. It will go through some of the kind of impacts. I know John's got some slides teed up on what the financials will look like, but really it will kind of drastically change the way lease accounting is currently for both lessors and lessees. We have at the bottom of the slide just kind of the overall timeline. That is still to be finalized by the boards. It's looking like it's about a 2017 effective date, although they have not yet made any affirmative statements other than it would be no earlier than 1/1/16. So you're looking at planning for a 17. I know companies that many of us have worked with have planning assumptions of either late 16 or 17. And the key point though is the boards have indicated that this will be retrospective. So you will back up to your opening balance sheet, reflecting the comparative financial statements. So assuming an effective date for a public filer in the U.S. Of 12/31/17, you would back up to 1/1/15 for that opening balance sheet creation. And I think most companies that have been looking at this challenge have realized that this is it's not something that you can do retrospectively in 17, but you really have to get ahead of the curve and be ready for that opening balance sheet as the portfolio of leases evolves. So that's kind of high level where we stand. John, if you could maybe move to the next slide. We'll go through a little bit more detail the new models that the boards have proposed. There really is a kind of a model for leases that are property related. and this relates to the expense recognition pattern, and then those that are non-property related. So we'll go through that in just a bit. And then also the lessor and lessee, just kind of looking at from different angles there. The boards have tried to create some degree of symmetry between lessor and lessee accounting, but there are some nuances and things to be thinking of and comprehending as well. So then the real key here is what are the kind of key challenges and what are the things to be thinking about in advance, and that's the purpose of this webcast. We'll be covering on many of these topics as we get into the session, but just to kind of start the thinking around this, firstly is just the visibility of many organizations to their lease portfolio. Many companies that we meet with, one of the first things they say, they don't really even have a feel for how many leases, where the leases are, what state of leases, what state the data is related to those leases. So the visibility of the portfolio is a common challenge that we hear. Another thing that we commonly hear is just there's not really a way to understand the pro forma impact of the standard. A lot of times there's a large number of leases involved, and the calculations to get the impact, there's a number of calculations that have to be run in determining that present value of the right to use asset and the liability, and so there's not really an ability to be able to do that what-if scenario analysis. Solutions, and then we're going to have a segment on systems during the session, and just understanding what are the available options that are out there. There are some short-term solutions that are currently in the marketplace, as well as longer-term solutions that companies should be thinking about. So these are just some of the topics that I want to just get on the table just to start with. As we go through the panel discussion, we'll cover upon many of these topics.
Thank you very much, Sean, for jumping in like that and covering the first few intro slides. We're going to go ahead at this point and saving our bacon there. We're going to go ahead at this point and launch the first of what will be 3 polling questions. So you should be able to see that up on your screen right now. As I mentioned up front, if you're here for CPE credit, as well as just the pure education, you must answer all 3 of these CPE questions. But even if you're not, we'd love to see where folks stand on this. And if we have time at the end, we're going to go ahead and turn these polling questions around and ask the panel for comments on what they're seeing here. So it'll be interesting to see where you stand relative to your peers. So I'll go ahead and leave this out for another 5 seconds. If anyone who hasn't had a chance to vote yet, we'll go ahead and get the vote in, and then we will get to the next speaker. Okay, I'm going to go ahead and close that down, and we'll get to our next speaker. It is my pleasure to introduce Angela Aman. She is the Manager of Accounting Policy at General Mills, a group that is actively engaged in the development of global accounting policies, the adoption of new accounting pronouncements, and the research of various accounting matters at General Mills. Before General Mills, Angela was the Manager of External Reporting at Target Corporation and a Senior Manager in the Audit Practice at KPMG. She holds a BS and a Master's degree in Accounting and a BA in French. Angela, thanks so much for joining us this morning.
Thanks, John. I've been following the Lease project for about 3 years now, actually before I joined General Mills. And I've also done some benchmarking with other large multinational companies in the Minneapolis area. I wanted to talk a little bit about getting started on this journey, as well as considerations along the way that I've learned in my own experiences and from other companies. So as you look at this slide here, if you're like many companies, you have leases around the world, and they're in various formats. They may be electronic or paper, and you may not have a central database for all of those leases. So it can be very daunting when you think of that. So let's talk about getting started. First, some of you may ask, why now? If they haven't already, either your audit committee or your CFO will ask you what the impact of the proposed standard will be. And let me tell you, you don't know what you don't know. And until you start digging in, you won't have any idea how long it will take to answer those questions. So what should you do? First, you should educate yourself and your team. So webinars like these are great. There are a lot of articles out there. You could even have someone from the Big Four accounting firms come in and talk to you. Then it's really important to strategize. This is a major project management exercise, so you need to set objectives and identify your key stakeholders. And make sure you get buy-in early from those stakeholders and take them along as appropriate. Once you have your plan, it's time for the basic blocking and tackling. So one of the first things to do is to determine the best data collection method for your lease inventory. And this is mainly if you don't have a central database. So you have to think about, should you do that? Should you build something in-house? Do you have the expertise? Do you have the time to do it? Or should you look external? And you may want to consider talking to advisors like the people on this call. They're all willing to show you how they can help in this process. So let's move on to some considerations. First, you need to determine the location of your leases. We talked a little bit about centralized versus decentralized. You also have to think about any embedded leases you may have. Another way to start is really just start working back from your rent expense disclosure, and a lot of companies have done that to try to figure out where your leases are. Think about the availability of your lease contracts. Do you have copies of all your leases? Do you need to go back to the vendor for those? Next, for the data collection template, think about the completeness of the data attributes to minimize going back and forth for more data and making sure you have the data you need to perform analyses. Also consider the familiarity of data preparers with the accounting attributes of a lease and the ability to fill out the template you're giving them. Will you need to train them on it? Think about upfront communication and buy-in to ensure the data is received timely from the locations. Remember, they already have a day job, and this is probably one more request from corporate. International locations introduce additional complexities, such as managing different languages of lease contracts, as well as the English fluency of the data preparers to fill out the template. How will you ensure that these are filled out properly? Overall, ensuring the completeness of the lease population as well as the accuracy of the data received is very important, because this will form the basis of your financial reporting under the new standard. Also consider assumptions for your analytical models, such as what ratios your company will want to analyze and what level of data disaggregation do you need. So those are some takeaways, although each company will likely have its own unique obstacles during this process. Now I'll turn it over to a polling question.
Great. Thank you very much for that quick overview. We're going to be hearing a lot more from Angela when we get into the Q&A and the panel discussion. But at this point, let's go ahead and pop up the second of our 3 polling questions, which should be hitting your screen right now. So where do you see the biggest impact on your organization from these coming changes? I'm going to remind folks, ask questions at any point in time via the question section of your GoToWebinar control panel. It might be hidden there. You might have to hit the little plus next to questions, and then you'll see where you can ask your questions. And we just had someone actually ask, where can I get a handout to follow along with? So for those who are just joining, we're coming on a little late. The presentation is already available at proformative.com/resources. It will be out there. It's freely available. Just come and grab it. And that's there in case you want to print it out, follow along, etc. Okay, I'm going to go ahead and close out this second polling question, and then we will get into the next section of our presentation. Now, this next section, we're going to be hearing from a number of folks, so please allow me a minute and a half or 2 minutes here to introduce all 4 of these people, which I'll do, and then we can hear from them uninterrupted. So I appreciate you giving me a moment for these introductions. First, I'll introduce John McGaugh. John is a partner in KPMG's Accounting Advisory Services practice and has 21 years of experience delivering advisory and audit services in more than 17 countries. As KPMG's Accounting Change Services practice leader, John coordinates the integrated delivery of U.S. GAAP and IFRS conversion services by partners and professionals from KPMG's audit, tax, and advisory practices. Most recently, John has been leading the development of KPMG's new leasing standard service offering and related implementation software. Since 2004, John has served as the global lead partner to McDonald's as well. Next, Miles Corson, who is a principal in financial accounting advisory services with Ernst & Young. With over 16 years of global accounting experience, Miles specializes in coordinating and leading multinational audit engagements for UK-listed companies. He's currently based in New York and is the market leader for Ernst & Young's financial accounting advisory services in the Americas. Miles has extensive experience leading IFRS and U.S. GAAP convergence projects for some of the largest companies in the U.S., including a number of Fortune 50 companies. Also joining us this morning is Rich Stabula, a director of in the advisory technology practice at PricewaterhouseCoopers. Rich has 16 years experience in providing assurance and consulting services to clients. He specializes in providing project implementation support, business process optimization, and pre- and post-implementation reviews for clients in an SAP environment. He co-leads PwC's finance transformation practice with a focus on assisting clients evaluate their financial processes and drive improvements in business processes that are supported by technology. He also leads PwC's national IFRS SAP practice. And finally, Sean Tor is a senior manager at Deloitte & Touche with Deloitte & Touche's Financial Accounting and Valuation Services Group. With over 15 years of experience at Deloitte, Sean has focused his career on assisting clients in meeting their financial reporting requirements, including the implementation of new and converged accounting standards and IFRS. Additionally, Sean serves in Deloitte's IFRS and Convergence Program Management Office and is a frequent speaker regarding the implications of IFRS and convergence-related topics. Okay, done with the introductions. Thanks for bearing with me there. First up to speak is going to be John McGaw, who's going to walk us through a slightly deeper look at the proposed accounting models. John, please.
John, thank you very much, and hello to all of the attendees on today's webcast. Thank you for sharing your time with us today. As Sean talked about earlier, we do have a project that's been going on for many years now, and for those of you who follow it, you've seen that we've actually had some fairly significant changes in direction of where the standard is going. And while we won't have the time today to get into all of the nuances of the standard, a couple things that I wanted to point out when people ask, why is it taking so long? Why are we seeing these fairly significant differences in tentative decisions that are made by the board? A couple things that I would point out to you that may help you understand as your companies may start to look at this is, one is we do have a joint project between the FASB and the IASB, so when you have more parties involved and parties that have different constituencies, that can help us get to a better answer, but it can take more time. Also, when I mentioned the constituencies, there's a couple of different factors at play here. One is that you have the theoretical accounting considerations that are going on. Are all lease transactions the same? Do they, in a conceptual framework, represent a liability that should be reflected on the book? So there are a lot of conceptual accounting matters that are being debated. At the same time, you have the preparer community that's looking at it and going, irrespective of the technical accounting merits, there are some cost-benefit considerations to some of the requirements that are being proposed. So you have the preparer community going, okay, I understand what you're asking for. Let us explain to you what that means from a practical application, and the other panelists are going to spend a little bit of time talking about what some of those issues might be. On the other end of the spectrum, you've got the user community, the analysts, financiers, and others that are saying, hey, here's the type of information that we need based on what we have today. Either we like that or we'd like for you to do something different. So you've got another constituency that's pushing for information. And then last and certainly not least is that if you think about the leasing industry today on a global basis, leasing transactions, whether it be on the equipment or the real estate side, involve billions and billions of dollars. There's a large business built around it, and some people are wondering how might this standard impact the business models, if you will. And so obviously you've got that constituency who's also providing a lot of feedback here. So you've got all these different constituencies with different points of view. And then also, as the slide shows here, we're really dealing with two models. They're dealing with a lessee model and a lessor model. And I think, as Sean was right to point out, they are trying to align them as much as possible, but there are differences if you look at it from the lessee perspective or the lessor perspective. Without getting into them, I'll also tell you some of the matters that these different constituencies are that the boards are giving consideration, are dealing with items such as, what is the definition of a lease and what things meet that. So if we have a new lease accounting standard, which transactions will fall under it? What is the lease term? Many leases have renewal options, and how do we consider terms under them? What types of payments are we looking at? Is it all lease payments, or do we treat contingent payments, such as payments that are based on a sales volume or use volume? How do we include those? There is also an area that's receiving a lot of attention in terms of, once we do the initial accounting, many of you may have heard of this concept of reassessment. How do we periodically reassess what we put onto our books? So there are lots of different issues that they're dealing with. I think in advance of this webcast, many of you had sent some earlier questions in that dealt with, I hear that originally the intent was to move to one model. I now hear that we have currently tentatively decided 2 models. So I thought we'd spend just a couple of minutes talking about that. And as you see on the slide in front of you on the right-hand side of the page, from a lessee perspective, which is really the focus of today's webcast, we are currently at 2 different models, which we'll spend a little bit more time talking about. Real briefly, I'll also point out to you that on the lessor side, and the reason I bring it up to a lessee community is there's 2 parties to a transaction around leasing, and I think it's helpful for both the lessees and the lessors to understand how their counterparty to the transaction is impacted by this proposed new standard, such that you understand their point of view. And in short, what I would tell you on the lessor side is that many arrangements, and if you think about them, and I'm speaking in broad terms, if you think about many equipment leasing transactions today, which from a lessor perspective are accounted for as an operating lease, could look more like a sales type or a financing type of transaction in the future. So there is an impact to your counterparty in this. I think it's just helpful for you, even if you're not a lessor, to follow what's happening in the development of the lessor model as we go through the standard setting activities. As we move to the next slide, and we'll talk a little bit more about, well, if we've got 2 different models, what do they mean? For any lease, there is a general principle or presumption that the lease is a financing transaction. So when we talk about putting leases on book, what you would be doing is present valuing your future lease payments as defined, but you would be present valuing those, and for either type of lease, you would actually be setting up a right to use or a right of use asset and a corresponding liability to make future estimated lease payments. And again, irrespective of how that asset may come off the books, which we'll talk about, that's how you would bring the lease onto your balance sheet. And the liability itself actually would be accreted using the effective interest method, similar to what you would do with debt today. Where we currently stand, though, going forward is, once we have this right of use asset and lease obligation on book, how do we take it off book? And there are currently 2 proposed models. One is the interest and amortization method, and the other is the single lease expense, or SLE method. I would tell you in layman's terms, the interest and amortization method looks an awful lot like today's capital lease accounting, both in terms of setting up the asset and the liability, and then the corresponding impact on your income statement. And if you look at the chart below, the line that starts at the lowest and goes to the highest, that's illustrative lease payments. In this particular example, it's a lease that actually has increasing payments over a period of time. And under the interest and amortization method, because you have an effective interest method where earlier in the life of the lease you have more interest expense, you would have a situation where you have front loading of expense, such that earlier in the life of the lease you see more expense, and then later in the life of the lease you see less expense. And again, that interest and amortization method is a combination of both interest expense and amortization expense. Generally speaking, most equipment leases today, or I should say other than real estate leases today, would likely follow that model. That's not an absolute, and the boards are spending time about how you would make that determination. But generally speaking, think of your other than real estate leases as following the interest and amortization method, which could be quite different than your operating lease treatment today, both in terms of timing and P&L recognition in terms of rent expense today versus interest and amortization tomorrow. The boards have now introduced a second model, which is referred to the single lease expense method, which in short provides one line item in your income statement called lease expense, and it is effectively a straight line expense recognition. And without getting into the details, the way that it's achieved is that it's an accumulation of interest expense and amortization of the asset such that they give you a straight line impact. So if I step back to close this out in summary, what you're looking at is that all leases would originally come on book at the present value of your future lease payments. And then companies would go through a determination of whether or not you would follow the interest and amortization method. And generally speaking, that would be most equipment or other than real estate types of transactions, or you would follow a single lease expense, which generally speaking would be more real estate transactions, and such that you would have on-balance sheet treatment, but you would not have the accelerated P&L charge associated with the interest and amortization method. With that, John, we'll turn it back over to you for us to get into the impacts, and I would comment that for all the changes that the boards are still struggling with, a lot of the impacts that we're talking about today, and I would say certainly the activities that Angela talked about, I thought that was a great overview of what you might do. Those things aren't really impacted by the decisions that the boards are making. So still can be a high return on your investment even with ongoing standard setting activities.
Great. Thanks, John, for that quick, slightly deeper dive into the impacts and some of the specifics around the new regulations. Appreciate that. Now we are going to move to the next section, which will have us hearing about these 4 main impact areas. And we'll be hearing about these from each of our 4 panelists. And actually, we're going to go right back to John McGraw here to tell us about accounting and reporting impact. So, John, why don't you go ahead and grab the mic again?
Okay, absolutely. And no two companies will be the same here. But when you look at the types of changes that are being considered, a couple of areas jump out. And Miles Corson is going to talk in a few minutes about people and change impacts. So I'm not going to dive deeply into these, but some of the things real quickly are, generally speaking, we're going to see increased management judgment, whether it's around the definition of a lease or how you identify lease term, lease classification if we have 2 models, again, the single lease expense versus the INA that we just talked about. All of those areas might require increased judgment. We are seeing the influence of the IASB, or the International Accounting Standards Boards, that we may see more principles-based guidance rather than the bright lines that we see under current U.S. GAAP accounting today. So increased management judgment. What typically follows that is you could have an increased level of effort just to execute the requirements of the standard. A couple of other items is that once you put a right-of-use asset on books, you now have to worry about the impairment of that right-of-use asset, going on down the list, and each of these require additional analysis within your company, but things to think about. A lot of times today, book and tax treatment for leases are the same. You may now be creating new book tax differences to be tracked. Companies may need to significantly amend your accounting policies and procedures depending on the types of lease inventory that you have. You will see potentially more onerous disclosure requirements around the standard. And then ultimately, we're talking a lot about what the day 2 looks like, but there's going to be an effort to go through and transition and move to the standard, all of which your organization is going to have to support at a level that you're comfortable for financial reporting, and that your external auditor ultimately can audit and include as part of their overall audit conclusion. So with that, I'm going to transfer it over now to Rich to talk about the system and process impacts. If that's the accounting, Rich, what's it mean to us in terms of system and process?
Thanks, John. Well, yeah, absolutely. As everyone can see, there's a lot of changes that are there from just even an accounting perspective, but you have to tell everyone that really accounting is just the tip of the iceberg here. It's obviously very important, and it's the lead issue here. But backing up all that accounting, of course, are going to be all your systems and your processes, as well as your controls. So, organizations out there do enter into leases currently, right? So there are going to be some processes and systems and controls that they have in place. There's a business need to buy a piece of equipment. You're going to do some requisitioning with procurement and purchasing and enter into negotiations with vendors and contract with that vendor, right? Those are processes that organizations have in place, and some of them may be manual and is supported by spreadsheets, and some of them may be fully operational under some kind of system components. But based on the discussions that we've had so far, you can see that a lot of these changes are going to have some significant impacts as to how these processes are going to have to now realign with the accounting standards and the information and the reporting that's going to be required to support it. So you can definitely still start these processes, with the business need. Obviously, all that's important, and you're going to start looking at entering into requisitioning of that equipment. But before you even want to enter into any kind of negotiations, you're going to start wanting to look at some kind of a lease or buy decision now, because of all the standard changes that are potentially down the line here. There's going to be some rationales to maybe you're going to have to ask the question: do I want to just not lease this asset, but do I want to just buy it? And there's going to be some considerations in there where you're going to want to look at discounted after-tax cash flows and financial cost factors, as well as non-financial cost factors. So that's something that's brand new in the process now that really has to get considered before you enter into the final negotiations with the vendor to enter into these leases. Not only is there going to be changes in processes, but there's also going to be changes of who's going to be involved in these processes. So in the past, maybe it was just something that the business initiated, the procurement facilitated, and legal reviewed. Now you're going to have to also involve your finance and tax organizations in these processes, because they're going to have to understand the impacts on the disclosures they're going to have, as well as the impacts on the systems and the things they're going to have to record now. Because now there's going to be some fixed assets components involved in your systems. You may be doing more project accounting of costs and stuff like that in a more formalized manner, and gathering the information from a disclosure perspective to really be able to support this reporting requirements that are required, not just for leasing as it's going forward, but even from a dual perspective, because there's going to be a period where we're going to have to report both standards in that transition. So the systems and processes are going to have to be supportive enough to be able to maintain that over the dual reporting period. In addition, I'd like to add a little bit more. I mean, a lot of clients are asking out there is, we see this impact. We see there's a lot of impact on accounting, business, and processes. Where do we start? And Angela teed it up very nicely in the beginning of this, and I'd like to just expand on it a little bit more. I mean, this is a transformation. Every organization will have some level of impact here, some more and some less. It just depends on how complex everything is for them. So really, setting this up, you really have to start with some kind of an assessment that really sets the stage, gets good understanding, gets buy-in from the organization, and starts the path going forward. And what is key, is very key to this process, is going to be inventorying your leases. And as Angela mentioned before, it's not going to be a very easy process. It's going to be something that may involve some significant effort. The key elements of that are going to be really collecting the data and getting it all, getting it from all over the world, and really understanding that there's going to be some incompleteness there. Some leases will be missing and stuff like that they're going to have to go back to their lease vendors to really be able to gather some of this information. Standardizing this information. There's going to be differences in language that have to be considered, and that translations have to be done, as well as really just agreeing on what are the standard data elements we're going to need to capture from all these leases, because we're going to need to analyze these leases to be able to understand what the impact is. And to do that, you're going to need to gather a series of standard data elements that you're going to require from these leases. And then after you have those data elements, you're going to need to centralize them somewhere so you can do that analysis, some kind of a database, a spreadsheet, or some kind of a mechanism to be able to gather, analyze, review, and really go into the next stage of this assessment, is really understanding the impacts and where to go from there. So with that, I'd like to turn it over to Sean.
Thanks, Rich. Great. And yeah, we've spoken now about the accounting and the systems, which are the common topics that everyone's asking about. I think what we don't hear as much is, what is the impact on the business? And then Miles is going to speak about the impact on people. And these are things that maybe lower in the kind of the priority list for many people. But I think when you look at the broader operational considerations related to this change of accounting, there are some significant potential impacts. And so companies that are kind of being proactive with this are really looking at assessing what those implications are, kind of developing a strategy to deal with those implications, and then communicating with the appropriate stakeholders. So maybe we're going to spend a few minutes kind of talking through some of those things. The first one will just be in terms of the financial statement impact and the users of the financial statements internally. We've gone through, John went through the different models that we now potentially could have, and it really kind of muddies the water as it relates to lease accounting. There's now, there's two different models for the expense treatment. So your P&L could have three places where lease expense could land, and it's really kind of working with your business units and being able to articulate that. Lease accounting is hard enough to articulate to the business anyway, but now you've got this additional complexity to kind of make sure that people are aware about, and then so that they can understand the consequences of the decisions that they're entering into. Up until now, many companies have tried to structure transactions to achieve objectives of maybe getting leases off the balance sheet through various mechanisms, securitizations, and so forth. Well, now that really goes away. You've got everything that comes on the balance sheet, and it's kind of thinking about, does the company's buying behavior change as a result of some of these impacts? Really comes down to, again, volume and size of the lease arrangements relative to your existing financial statements. But some of this could be things that you need to be thinking about. The other thing would be in terms of key ratios and key performance indicators. Because the geography of both the balance sheet and the income statement will be changed quite significantly because of this for those companies that have large volumes. There is the potential impact on key ratios. So ratios such as return on assets. Well, now you've got obviously more assets on the balance sheet, so that return relative to the assets is going to be lower. Thinking about the debt to equity arrangements and the impacts of that, as well as things like EBITDA. Now you have this new amortization that's going to be basically added back in an EBITDA calculation, and that would need to be thought through if that's a key performance indicator for the company. So it's really kind of thinking about what are the impacts to the ratios, to the users of the financial statements. That's pretty key here. And then thinking about the whole budgeting process and the forecasting. So many companies may be in their kind of doing some midterm planning. So if you're looking at 3 to 5 years out and trying to forecast out that far, you're really forecasting into this time of accounting change from a lease perspective. John had articulated the INA method, the accelerated expense pattern, and so how does your portfolio drive your net income into those midterm years is going to be a key thing for companies trying to get their heads wrapped around sooner rather than later. And then just making sure that the external stakeholders, analysts, the lenders, investors, and others are fully aware of the kind of impact to the metrics you typically report to them. So those would be the kind of the financial statement pieces. There's other things that I guess is some silver lining to this to a certain extent, in that there is a greater degree of visibility into the lease portfolio, and there may be some economic benefits that can be derived from that visibility. So does that change your buying behavior? Are there kind of economies of scale you can achieve by maybe shifting to certain vendors and so forth? Maybe give you some additional purchasing power in that regard. There is some benefits to that visibility beyond just the accounting, the kind of topics we've mentioned so far. And then another point that it relates to the business is just how does the company enter into arrangements. There's a number of things that there's judgment, and there's pretty significant differences in outcome if you go one way or another. So, for example, renewal terms. If you have a significant economic incentive to renew, then you would include those terms in your calculations. So the question is, will companies look at structuring transactions to meet objectives that may be more beneficial in the long run? So just kind of thinking about those types of topics is something that companies can think about. The list is long in terms of the kind of peripheral impact to the business. I think the most overriding thing, though, you would notice is that there is a greater need for synchronization between the folks that are administering the leases in the business and the accountants, because the profile of lease accounting has increased significantly now, with it bringing on the balance sheet and the variability in the P&L. That synchronization between the business and accounting is key to making sure that you get it right. Just more of a carry-on, and this really ties in very closely to the topic we just covered on business. It also ties into John's section on the accounting and the judgment. Really making sure that there is adequate training for the folks that are exercising that judgment is going to be very, very important, and definitely underestimated by many people. The other key question is, at what point in the organization do you centralize or decentralize the making of those judgments? So we mentioned the significant economic incentive. That's a judgment point that has to be made, and do you feel comfortable pushing that out into the field, or do you want to hold that more centrally? So this comes down to an organizational preference, but either way, there's a significant amount of training that needs to occur to be able to accomplish that. The other thing that is kind of key here is you've got a number of different facets of the organization that are impacted by this. We've spoken about the accounting, the system, there's tax consequences, the treasury group is impacted as well. So thinking about how do you knit that all together, and organizations that are that are kind of dealing with this proactively are forming kind of small groups, project management teams or PMOs to really deal with that. Keep the cadencing. There's a lot of time, a lot of runway available to companies, but it's really cadencing the activities and making sure that the interdependencies are worked out so that the time doesn't run away from you. There are some long lead time activities, one being the data gathering that needs to occur, the system implementation that we've talked about. So really knitting those all together, and best done by a kind of an organizational change group that can really exercise that project management skill and governance over the project. So the communication, training, and project management are all very key things to be considering. And it really comes down to organization and how do companies generally carry out large-scale initiatives like this, because this is another large-scale initiative, and it's thinking about what works best in your organization in terms of how do you set this up. But the key point would be to make sure that you are thinking of this as a fairly broad impacting initiative for the company to deal with over multiple years.
Thanks. Yeah, I mean, I agree with your comments on the long lead time. I think the point I was going to make to the audience is clearly you can't look at lease accounting in isolation, because I think one of the biggest challenges organisations face right now is just the volume of change that's coming down the pike. So of which leasing is one part. There are clearly the other convergence projects, revenue recognition, which is probably slightly advanced of leasing in terms of when we think it's going to wrap up. Financial instruments, another example. There's also changes to stat reporting, with local regulators updating, changing standards. So finance organisations are going to be having to deal with that, as well as regulation like Dodd-Frank, and at the same time as all of the sort of the commercial issues they're facing around managing the business, taking cost out of finance, M&A, divestitures, whatever it may be. So I think the key message I would want want people to take away is understanding, the roadmap of how all of those projects intersect and interdepend is critical, because I think to be able to identify where the bottlenecks are and where the resourcing is required is going to be essential, and particularly in terms of the interface with IT that has a longer term budgeting horizon. I think getting those identified, understanding how you work through those is important, and I think one of the things with leasing is obviously starting to do some of the activities now in terms of gathering the information, identifying your lease contracts. It's something you can start to do now, and I think as somebody mentioned, that investment isn't going to be wasted. It will have value, but it's something you can bring forward to try and smooth some of those resourcing issues. So I think the other bits I was just going to touch on briefly were education. I think Angela alluded to it in her opening remarks, and I think that operates at a number of levels. There's educating finance teams in the field and deciding what level of education you want to give in terms of the estimation and judgment that's required, that I think John alluded to. So are you going to what are you going to explain to people, what they need to be identifying in terms of the lease contracts, what to be looking for in terms of, what currently they may not be identifying as lease contracts. And again, Andrew alluded to embedded contracts in sales that exist within organizations that perhaps aren't currently identified. So you're thinking about how you manage that process, how you manage outside of the finance organization. I think we've talked about legal, real estate, treasury, where those organizations are involved in currently negotiating lease contracts that will be caught under the new standard, how they're factoring into negotiations. And also I think in terms of sales and operations, for a lot of organizations, contracts involving the use of assets, and whether those assets are specified as to part of the contract could lead you to thinking about changing how you strike the contracts that you're currently negotiating. One example of that would be for organizations that deal with government contracts, the treatment of interest under those contracts. You can't reclaim interest, which you could have some consequences of the way the new accounting guidance works. And I think obviously for a lot of organizations, educating their boards of directors is pretty significant. So I think those are the key points I wanted to just touch on. And then in terms of process redesign, Rich touched on the implications with Treasury around capital approval processes, around tax, in terms of making sure the data points that are required for tax analysis are gathered. So I think hopefully the audience would have taken away the idea that this is more than just a finance issue, and so I think getting the key stakeholders across other service lines, across other functions within the organisation is going to be critical to the success. So, John, so that's a quick canter through.
Great. Thank you so much for that, Miles. And let's go ahead and hop into the third and final polling question, which I'm going to launch right now. We are definitely running for our hour very quickly here. I hope we have time for a couple of questions, but let's go ahead and get this done. While folks are answering this question, I'll go ahead and remind you that there will be a brief, just 60-second survey after today's event. We appreciate your feedback, and I certainly apologize. I know we've had two audio issues, which we've never seen before, so my apologies for that. But if you would like to learn more, if you'd like to follow up with any of today's speakers or the sponsor, SAP today, after this event, we make it very easy in a post-event survey. Just a click of a mouse, and then we're happy to help with introductions to the speakers, to the sponsor, etc. So we greatly appreciate your coming and spending the time with us, and we'd love to get your feedback about the content of the speakers, etc., and what we can be doing better next time, plus what you liked. With that, I'm going to go ahead and close down this final polling question. I think given the time constraints, we're probably not going to have time to put the answers to these questions back in front of folks, but we'll actually work on aggregating them. They're all anonymous. We'll put them onto the website so that folks can see where everyone stands here. So we've got time for a couple of quick questions. Angela, I'd like to ask you the first question, which is how is General Mills utilizing technology to help with this process, given how far-flung your organization is, your company is, and this is such a complex task. Have you been able to leverage technology effectively to help in this process, or are we still dealing with a lot of manual processes, paper, et cetera?
So that was one thing early on that we wanted to identify, because we knew that a longer-term IT solution was not going to be available, but we wanted something that could be potentially a short-term solution that would feed into a longer solution. So we did sit down with each of the firms and had them walk us through what kind of models they had, and we did select one of those, and so that is what we are currently using for our inventory, but it also has an analysis piece to it and should be able to be fed into a future IT solution. But I mean, that piece is key, to have a good IT solution to work through all of this, because trying to do it in yourself in Excel, I mean, it's mind-boggling how difficult it is.
Madness. Right. And did you have all of your lease documentation online prior to this, or has there been a concurrent project of not just getting some sort of tech platform in place, but also doing some sort of project around pulling all of those documents into an online solution?
I would say that we were better in some areas having centralized information, and in others we were not so good. So it definitely was a process to figure out how best to figure out where that information was stored and try to pull it central.
Yeah. And Pete Graham, are you back on the call for chance?
Let me see if you can hear me.
We can hear you fine. So Pete, what are you seeing your clients do with regards to getting their arms around the lease challenge with regards to technology solutions?
Well, it's a great question. I mean, we've talked to over 500 customers in the last 12 months on leasing, and they come at it from different angles. Some are just starting, and some are quite advanced. And for the most part, depending on which customer can't we find, we either have kind of the data capture discussion about how best to start getting your arms around the problem. And I think all the panels here are working with customers on the accounting impact related to that. And then other customers come to us with very specific questions, typically around the lessee area, and that's where we have some solutions or potential solutions that we're working on, and that's typically what we then cover with customers and how they could solve those problems going forward.
Great. Thank you very much for that. I hate to say it, I want to be mindful of everyone's time, the speakers and audience alike, and we've got about a minute left here, so I'm going to go ahead and close this down. I will tell you we have a number of questions. I'm going to work with today's presenters to see if we can't get those questions answered online at Proformative, where everyone will be able to see them, just as if you're on the webinar. I apologize. We had so much great content that we tried to squeeze in here, and I'm happy that we did have time to hear all of the content that these folks have gathered today. A couple quick items. We already talked about the survey. If you have any CPE questions, you can see Chris Brower's email at the bottom of this slide, so please feel free to reach out to her. SAP, of course, a great thanks to SAP. This is a great educational webinar. We couldn't ask for better speakers, better experts and practitioners on the line. And the fact that we are able to do all of this at no cost to our users ever. Everything online, everything we do with events is free for our users. We have to thank our sponsors and SAP in this case for their generosity, and we greatly appreciate their support. I'd like to give a quick shout out to all of today's speakers: Pete Graham, Angela Amon, Rich Sabilo, PwC, Miles Corson, Vincent Young, John McGaugh of KPMG, and Sean Tor of Deloitte, and that was Pete Graham of SAP and Angela Amon of General Mills. Thanks to everyone so much for your time and insights this morning. Greatly appreciate it.
Thanks for having us.
Thank you. Thank you.
Thank you very much.
All right, and a final thanks to our audience for being here this morning. We greatly appreciate your time. We know how busy everyone is, so hopefully this hour was well spent. I know I learned a lot, and there's a lot of information to cover here, so we appreciate it. There's a lot more information and conversations around this topic going on online on Proformative. We welcome you to join us there. And we hope to see everyone again on another Proformative event or online at proformative.com. Thanks to all. We'll hope to see you soon and have a great rest of your week. Take care.